If I had to start building dividend income today from scratch, knowing what I know about 2026 rates, dividend cuts, taxes, and how expensive basic life has become, I would do it very differently. Most people think dividend investing is about finding the highest yield, buying a few famous names, and then somehow living off the checks forever. But that is not what this is about anymore. Dividends are not magic. They are math, and the math can either protect your future or quietly fool you. Because if you don't understand how much capital you really need, you can spend years chasing income that never becomes large enough to matter. And if you chase yield without understanding risk, the company paying you can cut the dividend right when you need it most. So in this video, we're going to walk through how much you really need invested to live off dividends in 2026, why the biggest dividend is often not the safest dividend, and how I would think about income versus growth if I was starting today. Today is Friday, May 1st in New York, and I want you to comment what day and date you're watching from. And if you value content like this, support the channel by subscribing and commenting John A.G. Best. Now let's get started with the part everybody wants to skip, the formula. You take the yearly income you want, then divide it by the yield your portfolio produces. That is it. If you want $50,000 a year and your portfolio yields around 3%, you need somewhere in the $1.5 million range. If the yield is closer to 4%, you need a little over $1 million. If the yield is tiny, you need an enormous pile of money. And this is where people confuse a great company with a great income investment. Take Apple, amazing company, massive ecosystem, huge cash flow. But as a dividend machine, it is not built to pay your rent. Based on recently published company numbers, Apple's quarterly payout is now around 27 cents per share, after a small increase. That is fine. It shows strength, but the annual income per share is still just a little over $1. So if you wanted to live on Apple dividends alone, you would need a ridiculous number of shares, not a normal retirement portfolio, not a nice brokerage account. We're talking about the kind of position most people will never build from wages alone. And that is not an attack on Apple. It is just the difference between owning a great business and owning an income engine. One more thing that matters right now is the way companies return cash. Some businesses pay modest dividends but spend huge sums buying back stock. That can still benefit shareholders, but it does not show up as income in your account. Apple is the classic example. The dividend is small, while buybacks are massive. So an investor who only screens for dividend yield might look at the stock and say, that income is useless. But a total return investor sees a different story. Fewer shares, higher earnings per share, and potentially more value per remaining share over time. That is why dividend investors need to understand capital allocation. A company can pay dividends, it can repurchase stock, it can pay down debt, it can reinvest, it can acquire competitors. The best choice changes depending on valuation and business opportunity. A high dividend is not automatically generous if the company is underinvesting in the future. A low dividend is not automatically bad if the company is using cash intelligently. So the question is not, does it pay me today? The better question is management using cash in a way that increases my long-term wealth? That question keeps you from confusing income with quality. Most investors usually learn that lesson too late. So the dividend screen should be the beginning of research, not the finish line, and definitely not the whole plan. Now compare that with a more traditional dividend name like PepsiCo. Based on recent market updates, the company is still raising its payout, with more than half a century of annual increases behind it. The yield has been closer to the high threes, depending on the share price. That changes the math completely. Now the amount needed for $50,000 in income drops from fantasy territory to something closer to real retirement territory. Still huge, but at least now we are having a serious conversation. And here is where the trap begins. Once investors see that higher yield means less capital required, they start hunting for bigger yields, 5%, 6%, 8%. They think they found the shortcut. Winston would probably sniff the screen at this point and walk away, because even he knows when something smells funny. A high yield can be a gift, but it can also be a warning light. Dividend yield rises when the stock price falls, so sometimes the yield looks attractive only because the market is telling you the business is in trouble. That is the dividend trap. The income looks sweet, but the foundation is cracking. We've seen this with famous names. 3M had paid shareholders for more than a century and had a long history of increases. Then the dividend was reset sharply in 2024. The company still paid something, but the old growth streak was gone. AT&T also reduced its payout after the media spin-off. Walgreens went even further and suspended the dividend after a tradition that had lasted for generations. So when somebody says, this stock is safe because it has paid dividends forever, I think you have to pause. Forever is not a business model. A streak is not a balance sheet. A famous logo is not a guarantee. Dividends are paid from cash flow, and if cash flow gets squeezed, management can protect the business by cutting the payout. That is why I do not hate dividends. I hate lazy dividend thinking. There is a difference. Good dividend investing asks better questions. Is the payout covered by earnings and free cash flow? Is debt manageable? Is revenue still growing? Is the company raising dividends faster than inflation? Is the stock cheap because the market is emotional, or cheap because the business is actually deteriorating? That last one matters, because every dollar paid out as a dividend is a dollar not used somewhere else. It cannot reduce debt. It cannot fund research. It cannot build stores. It cannot buy better technology. Now, for mature companies, paying cash back can make sense. But if you are young and your portfolio is still small, you need to ask a brutal question. Do I want small income now, or a much larger wealth machine later? Most people under 35 should probably focus more on growth and total return than dividend income. Not because dividends are bad, because a small portfolio produces tiny income. A $10,000 account yielding around 4% only throws off a few $100s a year. Nice? Sure. Life-changing? No. That might cover a bill. It does not buy freedom. But that same $10,000 invested for growth across decades can become part of a much larger base. And once the base is large, dividends actually start to matter. Build the engine first, then ask the engine to pay you. If you reverse that order, you can slow yourself down. You become obsessed with monthly or quarterly income while ignoring the bigger compounding opportunity. And this is where total return investing enters the picture. A stock can reward you through dividends, buybacks, earnings growth, and price appreciation. Your account does not care which door the return walked through. Your future cares about the total pile. There is research behind this idea, and it keeps pointing to the same thing. Dividend-only portfolios often lean toward defensive sectors: utilities, staples, healthcare, telecom, and financials. Those can be useful, but they can also leave you light on the parts of the market that reinvest aggressively and grow faster. Technology is the obvious example, but it is not the only one. Now, here's the counterpoint. There are times when dividend stocks do extremely well. When growth stocks get expensive, when interest rates stay stubborn, when investors want real cash flow, dividend and value names can suddenly look very attractive. So I'm not saying dividend investing is weak. I am saying it is not automatically superior. A dividend is one part of return. It is not a religion. And the 2026 environment makes this even more interesting. Short-term treasury yields have recently been sitting in the high 3% area. Some high-yield savings accounts and cash-like products have been offering competitive rates. New I-bonds issued from May through October are paying a little above 4%, with an inflation-linked component. So if a dividend stock yields around 3%, you have to ask, why am I taking stock market risk for income I might get from safer places? The answer might be dividend growth. It might be capital appreciation. It might be tax treatment. But there needs to be an answer. This is why I like age-based thinking. If you are young, your main job is growth. Broad funds, consistent contributions, low fees, time in the market, and not panicking during crashes. If you are in your 30s, maybe you start adding a small dividend sleeve, maybe low single digits or a bit more. Not because you need the income today, but because you want to learn how those assets behave. In your 40s and 50s, the balance starts changing. You may have more capital. You may have family obligations. You may care more about downside protection. That is where dividend ETFs, high-quality bonds, treasury bills, and some cash reserves can start doing more work. Near retirement, income becomes real, not theoretical. You are no longer just trying to grow the pile. You are trying to turn the pile into groceries, insurance payments, property taxes, travel, medical bills, and peace of mind. That is when dividends can become powerful. But even then, I would not want one stock, one sector, or one yield number controlling my life. Diversification matters because retirement does not give you infinite do-overs. Now let's talk about the reality for normal households. The latest Broad Household Wealth Survey showed the median American household had net worth around the high $100,000 range a few years ago. Even if you adjust that upward today, you are still nowhere near the amount needed to live comfortably from dividends alone. Let's say someone has a little over $200,000 invested and somehow gets around 5%. That produces low five figures per year. Helpful? Absolutely. Enough to replace a full income for most families? No. And remember, that assumes the money is actually invested, not tied up in a house, a car, emergency savings, or retirement accounts you cannot freely tap. So dividend freedom is possible, but it usually comes after building wealth, not before. And if you are successful, share your success story in the comments so others can stay motivated. People need to see that this is not about getting lucky. It is about building a machine, one contribution at a time. Now, taxes are boring, but they can change everything. Qualified dividends can receive long-term capital gains treatment if the rules are met, including the holding period requirement. In 2026, many investors may see qualified dividends taxed at 0, 15, or 20% federally, depending on taxable income and filing status. Ordinary dividends can be taxed like regular income. That difference matters. A retiree with no job income, mostly qualified dividends, and the standard deduction may pay far less federal tax than someone earning a strong salary and collecting dividends in a taxable brokerage account. State taxes can change the picture too. So do not just look at the gross dividend. Look at what you keep. And here's another thing people miss. Reinvested dividends in a taxable account can still create tax. You didn't spend the cash, but the tax system may still treat it as income. That is why account location matters. A Roth-style account can be incredibly useful because qualified withdrawals may be tax-free later. A taxable account gives flexibility, but it can create annual drag. A traditional retirement account can defer taxes, but withdrawals can matter later. So the real dividend plan has several layers: income target, yield assumption, business quality, diversification, account type, tax treatment, age, risk tolerance, inflation. Not exciting, but very real. If you want $30,000 a year from a portfolio yielding around 3%, you are probably thinking in the neighborhood of $1 million. If you want $50,000, the number moves much higher. If you try to force the number lower by chasing yield, you may be accepting risk you do not understand. This is why I would not build a portfolio around the biggest yields I can find. I would build it around durability. Companies and funds that can survive recessions, rate changes, inflation, competition, and management mistakes. Then I would combine that with growth assets, because income without growth can lose purchasing power over time. A fixed dividend sounds safe until inflation eats the lifestyle it was supposed to fund. And that is the hidden danger. You do not just need income. You need income that can keep up. Groceries do not care that your yield looked good 10 years ago. Insurance premiums do not care. Rent does not care. Property taxes definitely do not care. So here is the simple playbook. When you are young, grow the base. When you are in the middle, balance growth with income and safety. When you are near retirement, design a real cash flow plan, but keep enough growth so inflation does not slowly corner you. And through all of it, stop worshiping yield. Yield is only useful if it survives. The big lesson is simple. Dividends can help fund freedom, but they do not create freedom out of thin air. The portfolio creates the freedom. The dividend is just one way the portfolio speaks. Do the math before you chase the income. Respect the business before you trust the payout. Compare dividend yields with safer alternatives. Think after tax, not just before tax. And remember, the goal is not to receive a dividend. The goal is to build a life where money no longer controls every decision. This is for education and perspective only. I'm not your financial advisor, and this is not a personal recommendation to buy or sell anything. Use this as a starting point. Check the numbers for your own situation. Understand the tax rules before making moves, and build a plan that fits your life instead of copying somebody else's spreadsheet.